Intelligence is what makes you start investing, and sometimes it's exactly what makes you lose a lot of money. The question of the day is: what investment promise does almost every beginner believe and pay a high price for? Welcome, friends. I'm Fred. Here we talk about investments, business, real life, and training, all from my personal perspective. When you start investing, you discover a completely new world. I remember when I first discovered the stock market. I knew the financial market existed, but I had no idea how it really worked. What is a stock? How do you buy one? Why does the price move? Then you discover futures markets, and suddenly your mind explodes. Futures, commodities, mini index, mini dollar. At one point, many years ago, I even traded corn futures, believing they were more stable. There's cattle futures, currency futures, so many markets. You feel like you entered a secret universe. And that's exactly where the trap begins. There is one way of thinking that fools almost everyone in the beginning, and it fooled me deeply. But here is the key point: this is self deception. Yes, the market allows this illusion to exist, but we are adults. We think, we choose. I don't believe the solution is regulation or banning markets. People will always try to sell illusions. The real responsibility is clarity, lucidity. So, what is the promise? The belief that your intelligence will allow you to beat the market. That somehow you will understand the market better than everyone else, that you will decode its logic, that you always position yourself on the winning side. And here's where things get subtle. Because intelligence is what brings you to investing in the first place. You think, I'll save money every month. I'll invest for retirement. I will build wealth. That's intelligent. But then there is a dangerous shift. You start believing your intelligence is strong enough to control outcomes. This illusion usually takes one famous form: buy low, sell high. Sounds simple, sounds logical, sounds intelligent. And yes, financial cycles exist. There are moments when markets are cheap. There are moments when markets are expensive. But here's the problem: understanding these cycles does not mean you can time them. There's a famous phrase in investing: time in the market beats timing the market. And beginners do exactly the opposite. They try to time the market. This is where intelligence turns against you. First, you try to time the market inside a single day. Day trading. You believe you believe you can predict how much it will go up, how much it will go fall, when to enter, when to exit. Then, if that fails, you try swing trade. Now you believe you can time weeks or months instead of hours. There is even the legend of people who always buy Petrobras here in Brazil cheap and sell it expensive. But here is the real question: can you emotionally survive this strategy? Can you watch your money drop 50%, 70%, 80%? Because what usually happens in real life is the opposite of the theory. People buy near the top, they panic during the fall, and they sell near the bottom. Now, let's compare this with a more humble approach: value investing, index investing, dividend investing. In all of these strategies, the logic is simple. If the asset is good and still makes sense, you keep buying, especially when prices fall. You don't need perfect timing, you need discipline. If you invest through an index, you buy consistently. If you invest for dividends, you buy and hold. When prices fall, you don't panic. You think, now my future income will be higher. The strategy stays intact. Let me give you a real example. For many years, Banco do Brasil was considered a dividend machine. Old company, strong presence, reliable dividends. And now, losses, political risk, uncertainty. Some people say, Fred, but it's a state-owned company. The government can interfere anytime. That's correct. But that's exactly the point. Even assets considered safe can change. This is why humility matters so much. Yes, you are intelligent, but not intelligent enough to predict every event, control market timing, anticipate every drawdown, know how long a downturn will last. Sometimes this lack of humility shows up during drops, sometimes during rallies. A stock goes up 200%, you sell, then it goes up 1,000%, 2,000. You see this clearly when you look at the history of major banks or large corporations. They fall hard, but over decades they rise. Now, ask yourself, if an asset goes up 2,000% and then falls 50%, can you handle that drop? Most people can't. And that's why timing destroys more portfolios than bad investments. So, here's how I'd summarize everything. The promise that fools almost every beginner is my intelligence will allow me to beat the market consistently. The truly intelligent move is realizing you are smart, but not smarter than the market. And that's perfectly fine because humility keeps you invested, and staying invested is what builds wealth. Have humility in your investments. Yes, you are intelligent, just not intelligent enough to control timing. And that realization might be your biggest advantage. Let me know your thoughts in the comment. I read and reply to all of them. Thank you for watching, and I see you in the next video.